So what do you make of these comments from Goldman Sachs? Jan Hatzius, the economist, Lloyd Blankfein, chief executive, don't raise rates.
Well, everybody, I don't think anybody has an idea, let alone the Fed, whether they should raise rates or not. Going into this meeting, and there's a lot of ambiguity amongst participants as well as in the marketplace. What's also important is not only the rate hike, but also, or if not, but also the message. Is it going to be a dovish forecast or a hawkish forecast?
So what are you telling your clients about tomorrow? Someone must be calling you and saying, Robert, what do you think they're going to do? I need to position the portfolio.
Well, one thing we've been looking at is, and that is maybe cause for the Fed to say, well, not this time, but maybe in December, which is the risk for another government shutdown and a debt ceiling. In 2013, Ben Bernanke decided not to taper in September, but postpone it to December because of the risk of a government shutdown.
So is that what you think is going to happen tomorrow?
I think that is a risk, and that is something they might take in consideration because the friction in Congress has escalated over the last couple of weeks, meaning that they may have a continuing resolution of maybe 2 months, which will coincide with the next time that the debt ceiling will be breached and the U.S. government may go into technical default. And we know those kind of discussions, when they happen simultaneously, as very, very iffy.
Go for it.
It seems, look, what do the markets think about this? I mean, they missed the boat in 2011. They haven't gone since then. If they miss the boat again now, will they ever go?
Well, you know, you read a lot of research that says basically, you know, a rate increase is not necessarily the death bell for a bull market in stocks. Obviously, every situation is different. And we had a pretty interesting story overnight by Lou Wang and Danny Berger on our team that looked at how this is different as far as the corporate profit cycle. You know, it's obviously very late in the cycle to start raising interest rates. And they looked at some interesting numbers from Ned David research that said, of all the rate increases going back to World War II, earnings growth has been averaging about 16% in the year before the rate increase. That's not the case now. Now we're looking at very, very weak earnings growth. In fact, last quarter we saw earnings shrink for the first time in this expansion. So it's kind of a very, you know, perilous time.
So earnings for the S&P 500 are shrinking or have been lower than they were in the past, right?
Right.
Okay. And now you get this rate increase. History, what does that tell us about the future corporate profits and stock prices?
So historically, when the rate hike comes, the initial rate hike like this, it's during a booming time in corporate profits, growth of about 16%. What Ned Davis research found out is that then in the year afterwards, that growth is sliced in about half to about 8% or so. This time, we're going into the situation with much weaker earnings growth, so it could have an even worse effect.
Robert, is it possible that the Fed has just missed this cycle? I mean, that we're not going to see any increases now?
Yeah, I totally agree with this dilemma, but the Fed is in a pickle because they said they were going to raise rates sometime in 2015 unless the world falls apart, and if they don't do it, they'll lose credibility.
But they're data dependent. They're so data dependent. They're data dependent. But if you didn't listen to Janet Yellen, she would tell you that they are data dependent. They depend on the data.
Aren't we all data dependent?
Yes. But so they can't be data dependent and raise rates no matter what, come hell or high water.
Well, they're looking at the unemployment rates. Right? And so one of the two targets for the Fed has been met. So they can hide behind that and say, okay, now it's time to raise rates. And also they want to normalize policy going into the presidential election next year.
Can I just try to summarize? You're saying that possibly, most likely, they're going to raise rates in December, not tomorrow.
Yes.
Yes, okay. And you're saying that corporate profits are not doing well, and this increase, 25 basis points? Go ahead.
The corporate profit footing is not on a great footing right now to absorb this. That said, I don't know how closely Janet Yellen monitors corporate profit growth, if only maybe as an indication of where unemployment's going to go. So,
all right. But I just want to. The question I want to pose to both of you is based on the performance, not of the domestic economy, but based on all of the upsets outside the United States. Does that influence the decision by the Federal Reserve?
Well, that influences the decision by the Federal Reserve indirectly. So if it starts to affect the U.S. economy, then it will definitely weigh heavily into their decision. As long as it stays offshore, so to speak, then the Fed is reluctant to use that as the smoking gun to decide to raise rates or not.
Okay. They take note, but they don't really care all that much. Or some version of that. Okay, all right. Thanks, guys. Very good.